Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Kevin, welcome to Flight 107 for the Pilot Money Guys. Thanks for joining me for this introduction to long-term care today. It's an exciting topic.
Yeah, I mean, Charlie, long-term care is, it makes you cringe a little when you hear it. But then when you start thinking about getting older or families getting older, it becomes really important. And it becomes super interesting when you need it. When you don't need it, you can just skip this podcast.
It is. Today's podcast is a little bit like doing squats. You may not enjoy it, but you need to do it, right? And it's one of these solutions. And we're going to talk about, real quick, I'll jump in. We're going to talk to Amy Arnett, DPL Insurance Solutions. I'll explain that in a minute. But we're going to cover standard or what's called traditional long-term care insurance, pros and cons of that. We'll talk about an annuity that has a long-term care rider, whole life insurance with a long-term care rider. And a rider just means in addition to that, kind of a hybrid. I think you call it a fusion sometimes, or a hybrid of the two. So there's different solutions, including self-insuring, i.e. not buying insurance at all. What does that look like? What are the pros and cons? And finally, we'll talk to what it looks like for some of our veterans out there. Are there solutions for veterans, maybe on VA disability, for long-term care insurance? I'll give you, a little hint, a spoiler alert on that one. There's not a lot of great information out there on that to definitively plan. If you're a veteran like myself, I can't quite plan on, the VA taking care of me under a long-term care situation. So that's what we'll talk about today with Amy Arnett, Kevin.
Yeah, it's not all or nothing, Charlie. You don't have to buy the Cadillac coverage anymore. You can do a bunch of different things.
Yeah. Amy Arnett is the VP of Insurance Solutions with DPL Financial Partners. Kevin, we partner with them and they help us provide insurance solutions for our clients. Since we are fee-only fiduciary, we go to an outside agency to help, kind of like a back office, help find those insurance solutions for our clients. And they're also a wealth of knowledge. And she has 36 years of experience focusing on life insurance, long-term care, disability, income for individuals. So she's very knowledgeable, and I learned a ton, Kevin, just during this podcast alone. So I think it's going to be very useful to those that are, thinking about this. And I think, like we said, it's not so exciting until a family member or a story where this has happened to someone. Then you get very interested in it.
Yeah, and we don't make any commissions, Charlie. When you say back office, they're not our back office. They're just going to help with the insurance. They can sell the insurance. They're either called no load or low load. So you do pay a little bit for their help, but you don't pay them the full commission.
Yeah, absolutely. So it's an arrangement that we've found helpful to us and to our clients. Kevin, we're going to cover one real quick question from the flight deck because I think it is, I don't want to say urgent, but really, really important in that we have a lot of folks that have, including you and me, Kevin, teenage or young adult drivers that could potentially be driving our cars. Now, let me back up a second because I skipped right to the subject here, but it's about liability and protecting yourself from getting sued, from having your assets vulnerable to a lawsuit. And if you're a teenage or young adult driver, let's say college age kid is driving your car with your name on the title, they get in an accident, they are found at fault, the other party will come after you, Kevin, on the title.
Yeah, I mean, it's about sue everybody. And so you can't sue the kid because the kid has no money. So the parents own the car. That's where you go. Yeah. And so, this is big fear of mine. As you mentioned, teenage drivers, they're almost no longer teenagers. Actually, they're no longer teenagers. Anyway, that becomes a concern. And Charlie, as all things, it's a risk. It's a real risk, and there's ways to mitigate the risk. And we're not going to get into it deeply here, but we do know it's something that you want to look at as a pilot that has drivers.
Yeah, and so consider getting, if possible, getting your name off that title of the car that your child is driving. And Kevin, as you mentioned, you went down this path If you do that, then you need to talk to your insurance company, and they probably need to be on their own insurance policy if you're not on the title as well. So a little bit of legwork on the part of the parents, but that will be helpful in protecting against some kind of liability scenario.
Or, Charlie, that's true. Or you can just get enough umbrella in coverage. Or there's other ways to make assets a little less obvious for a parent. So there's some things that you can do, and we're going to bring on an insurance specialist in the future, Charlie, to talk about this, and we'll get their opinion. But really, the key is just if you're thinking about this and you're worried about it, it is a good idea to take some action.
Absolutely. Awesome, Kevin. Thanks so much for that. We hope everyone enjoys our podcast today on long-term care insurance with Amy Arnett. Amy, thanks for joining us today on the Pilot Money Guys. We're excited that you were able to take the time to do that. We appreciate your generosity with your time as well. And coming up on Memorial Day weekend, so I know you're ready to get out and do some exciting stuff. We were just talking on the pre-show here about just you're from Louisville, Kentucky, or you live in that area. I'm from there. We love it. It's beautiful. A lot of our family are still there and everything like that. The question, though, that you had to answer when you were born was, are you a Louisville basketball fan or are you a Kentucky basketball fan?
I bleed red, so I'm definitely a Louisville basketball fan.
And I got to tell you, I bleed blue and orange, though, and orange now. I'm a Tennessee guy now, so I've got to do both. And Tennessee's got a good basketball team.
Yeah, they do.
I mean, really good. It's pretty amazing. So I'm certainly, bleeding both of those. But Amy, your specialty, your area of expertise is, and in fact, I was reading, you do all kinds of stuff, disability insurance, some other types of insurance. But today we're going to talk about long-term care insurance. We're going to talk about in general who needs it, why somebody might consider long-term care. And then you'll walk us through the different types that somebody might consider. And so we'll talk about some things to think about, the pros and cons of each. But one of the things, and just to open up, it's just like, why are we talking about this? Why is this important? And it's a tough one. Amy, I got to be honest with you. And when we're doing planning with our clients, it's like one of the toughest topics to address because there's no perfect solution. There's so many unknowns, and it's difficult to talk about sometimes too. And so we're going to talk about that today, the elephant in the room, so to speak, sometimes, in the planning world anyway. But in preparation for this, I looked at a lot of statistics of who might need it, how long. But, big picture, Amy, on your end, what are your thoughts as far as why is it important? And why is it a really important consideration in someone's financial plan? What are your big picture thoughts on that?
Yeah. So, as you know, I have personal experience with long-term care. So I have seen the value and the need for the insurance. And I feel like that, number one, just to mirror what you said, it's unpredictable. We don't know if it's going to happen or not. But as we live longer, because we've got ways to keep us alive and extend our life, and we're living healthier lifestyles, the odds of needing, a husband and wife of one person needing some form of care in the future is very high. And if you haven't planned for it financially, it could devastate a portfolio. You could spend easily $500,000 in expenses over a 5-year period or shorter for those needs. So you want to make sure that individuals are prepared to at least support that expense with one person. Otherwise, what assets they do have when it comes down to long-term care, if they're private paying, they're going to spend all of their money, and then they're going to have to go on a state Medicaid program. And, that might not be the pretty frame picture that they want to see. And why spend, 100% of your asset on long-term care when you could insure it and lean on the insurance company to cover a specific bucket of need and hand those assets down to your children.
Yeah. Yeah. And as you were talking, I was thinking about not only the costs that come up, and I can't remember the statistics. I think it's something like half or more of all people over 65 are going to need some form of long-term care. Is that close, that statistic from what you?
Yeah, it's very accurate,
Yeah.
definitely.
Yeah.
And the other thing too, Charlie, what a lot of individuals think of when they think of long-term care, they're thinking of nursing home, but it's designed for home health care, and people want to stay at home, and it's more expensive to stay at home for 24-hour care. So, if you think about needing the assistance that, for your activities of daily living, or there's a cognitive impairment, there's ways to keep you at home. And that insurance will support that as well.
Yeah.
So people are more friendly to it when they realize that, oh, I don't have to go into a nursing home. I can get my care at home.
Yeah, I think you nailed it there, Amy. That's what we've heard a lot too is, hey, that's our main desire. And it makes sense because what I was thinking about too was not just this financial burden that we need to calculate, but it's so emotional as well, right? I mean, when we have a loved one, whether that be us or our spouse, and a lot of our clients, we have a relatively young client base, but they're seeing it in their parents right now. And I think we've had a lot more conversations lately because it's earning the attention of our clients now going, man, I need to make sure that I'm taken care of and I'm not a burden either to my spouse or my children. And so we're certainly seeing that, a lot more attention lately. I think long-term care for me, I'll just speak from my experience, it's hard to really comprehend that. First of all, I'm going to be 85 one day, hopefully, God willing. And secondly, that I might need some help. It's really just hard to bring that into the present and plan for it. But again, as planners, that's what our job is to do, is to really help people to do that. And you alluded to it a little bit, but long-term care, I think sometimes I just want to define it. It is not medical care per se in the hospital. And we'll talk a little bit more, but long-term care means someone cannot do 2 of the 6 activities of daily living. And I'm not sure how this is actually played out. I'm sure every situation is dependent, but I'm assuming at some point a doctor says, hey, you can't do 2 of these 6 activities of daily living, and therefore you qualify for long-term care assistance. And as you said, that can vary between being in the home or being in a long-term care facility. Amy, can you help me fill in the gaps there and add to that, or anything that I missed there?
Yeah, sure. So, there's 2 triggers in order to qualify for benefit from an insurance policy. And one of them is unable to do 2 of your 6 activities of daily living. And you need substantial human assistance in those activities of daily living for at least 90 days. And the way that's documented is, when you're a parent or when you start going to the doctor, you need to make the doctor aware of things that are going on, because the insurance company is going to get those doctor's records in order to justify that you have qualified or met either the activities of daily living trigger or a cognitive trigger. And your activities of daily living are eating, toileting, transferring, dressing, bathing, and continence. And from experience, and I'll continually refer back to, the experience I've had, with my mother, my sister, I always went to the doctor with her. And as we sat with the doctor, we made note, her continence is questionable. It's not happening. And she needs assistance with bathing because she's unbalanced. So that's noted. Later on, she got a dementia diagnosis, but all of those things are noted. And so when it came time to file that claim and they ordered those records, it's documented in those records. You have some individuals that it's they have a lot of pride, and you don't want to admit yourself failing in any area. But when you have this insurance, it's important that those things are upfront and disclosed, because that's what you've paid for. That's what you want that benefit for. So, you've got to be open with your physician and be acceptance of the assistance that you're going to need.
Yeah. I think that is huge, what you just said, where you're telling the doctor and being proactive. And I can speak for, again, myself, and I know others I've heard where when we work with medical professionals, we kind of think that they know everything and we just sit there, be quiet and don't do anything. And they are, obviously they're a very, talented professional, but I love the way you frame that. Be proactive, tell the doctor, tell the staff what's going on so that when that time comes, it's documented. That's huge.
Yes,
I didn't even
it absolutely needs to be documented because
yeah.
that's the justification of
Yeah.
qualifying for your coverage.
Mm-hmm. Yeah. And two, just to reiterate, because the definition to me, long-term care, you cannot do 2 of the 6 activities of daily living that you listed. But I kind of left off that other one, which is huge, that cognitive decline, which I think would be Alzheimer's. Is that right? That would be the example?
Yeah, some form of dementia, and Alzheimer's is classified as a dementia. But yes, and there's a series of tests that an individual will go through in order to diagnose that cognitive impairment.
Okay, gotcha.
The other key factor too is maybe you've met one of those 2 triggers, but you also need to start receiving care in order for the insurance to pay. So you might have a very high functioning individual that has a cognitive impairment, but they don't need assistance right now. They can still pretty much do everything independently. It's just that things are starting to show signs of that cognitive impairment. So, those are important things that whenever we talk to individuals about long-term care, and we go through those details so that they're aware of the necessary steps and in order to qualify for benefit.
Yeah. Yeah, good. Because that seems like a kind of a gray area. Like, how does this play out? It could be different scenarios, different circumstances. But yeah, that's huge. And other parts of long-term care foundation that we're going to build here before we get into the specifics is just how expensive it can be. Like you talked about. I know the type of care, whether it be in-home or assisted living or nursing home care, is going to vary pretty wildly. But I've got on my screen, I think you gave us this website, carescout.com, is that right?
Right.
Sound familiar? Okay, and I'll put that in the show notes. But I put in our local area, I'm in Maryville, Tennessee, and it says in-home care, and this is 2024, is about $6,100 a month, I think is what.
And that's probably not even 24-hour care on top of that. That's probably 40 or 44 hours a week.
Yes.
I'm going to guess.
Yeah, we looked at that earlier. I think it was 44 hours a week. You're right. And then assisted living community, $5,100. I'm $5,100 a month. I'm not as familiar with exactly what that means as far as the level of care. But then nursing home care, I think private room nursing home care in my area, which is really a low cost area compared to Florida, Chicago, New York area, West Coast, for us would be about $10,000 a month in our area. Yeah. So those are pretty alarming.
Yeah, it is. And so my mom's in a facility. She's in skilled care. I'm in Kentucky, and the monthly cost is $12,000.
Oh, wow.
Yeah. And then to point out, you weren't 100% sure about what assisted living is. Assisted living is someone that can do some things independently, but they need, that assistance, and you buzz a button and say, hey, I need help showering. Hey, I need help dressing. But they have a little more independence until you move up into that nursing facility.
Okay.
They might have a little mini kitchen in their apartment. It's more of an apartment atmosphere than a room atmosphere.
Okay, that makes sense. And so if anybody needs help with the average cost in their area, CareScout, CareScout.com is a good place to do that. We'll put that in the show notes, but it can be eye-opening depending on where you're at. So Amy, as far as like how long we anticipate paying for this coverage, clearly we've got a monthly cost from $6,000 to $10,000 in my area anyway, a little bit more in yours. How long? What are the average statistics that I don't want to say we can plan for. You can't plan for everything, but maybe statistics to help us get a frame of reference here.
Yeah, the average stay for a male is 2 years, or the average need of care for a male is 2 years, and the average need for care for a female is 3 to 4 when it's an activity of daily living claim. When it's a cognitive claim, the average stay is 6 to 10 years.
Wow. Whew. That could be pricey.
It can be. But then you've got the other thing that those statistics are averaging is those individuals that go in and need assistance, and rehab, and they leave. They might need 6 months to a year of rehab from a stroke or something of that nature. A stroke's really an ideal situation or an example. It's not an ideal situation. It's an ideal example of, you have to go into rehab because you got to learn to maybe walk again, use an arm again, eat again. So those statistics are taken into consideration when we come up with those average numbers.
Yeah. And just to clarify too, the role, because I think sometimes we get confused what Medicare covers, what it doesn't cover. And again, this is not a medical thing we're talking about. It's the longer care after that happens, i.e. long-term care. But Medicare does help a little bit. In your example, you use somebody has a stroke. Medicare is going to cover, 101 days or something like that after the event, possibly, of rehab?
Well, it has to follow a 3-day hospital stay, and you have to go into a skilled facility. And then it's going to cover, I think it's the first 20 days in full. And then the next days, there's a copay. So if you've got your Part B and your supplement, it's going to pick up that copay. But the important thing and then it's going to end, and then you're completely out of pocket. So after 100 days, that's it. The other thing you have to make sure, and I learned this with my mother situation, is you're progressing and improving in order for Medicare to continue to pay. So it could drop off. It doesn't mean that it's going to. You have to be getting your therapy. You have to be getting improving in your health in order for Medicare to continue to pay through that first 100 days.
Yeah. Okay. That's huge. It's huge because I know sometimes we talk, hey, long-term care, and people go, oh, Medicare will cover. And it's like, well, maybe not. And definitely not if it's longer than a 100-day type scenario, which
correct
is really what we're focusing on today. Now, Medicaid, I think we'll maybe talk a little later, but just really quickly, just to clarify Medicare, Medicaid. Medicaid is for low to no income. There are basically numbers there that you have to meet for Medicaid to kick in, and it basically means you don't have any money left. I'll just put it that way, which is, sadly that happens sometimes, but that's what it's there for. So our audience, our client base, Medicaid is not something we want to count on, and probably won't be relevant for most of the people we're talking to today. But the final thing before we jump into the specific types, Amy, is in all of these cases, I know we have the statistic that you laid out there, the average stays, the average cost in our areas, and then we have these outlying situations where, boy, it could be 10, 15 years depending on, the diagnosis. But really, when it comes to insurance, and I would like to say managing this risk, we're just trying to do something reasonable to reduce the cost, to reduce the burden. We're probably not going to be able to cover all of it in every single case. So we're just trying to, I've heard some people say, hey, something is better than nothing in this area. So that's kind of what we talk about sometimes. Let's just try to have some kind of coverage because we just don't know what the future holds, of course. So we're just trying to mitigate that risk somehow.
Yes, absolutely. I agree.
Excellent. So
it would be cost prohibitive to try to 100% insure long-term care needs.
Yeah, absolutely. So what we'll talk now, we'll just kind of shift gears on some of these specific strategies. You and I talked yesterday a little bit about the different types. And so I think I'll maybe try four categories. You introduced me to a new category yesterday. So we'll go 5 categories now. But the first one is going to be what we call standard or traditional long-term care insurance. You pay per month forever, and it pays a certain benefit. We'll talk to that in a minute. And then we've got the group that are called hybrids, where we might have an annuity with a long-term care, what we call rider, just means it pairs up with it a little bit. We might have life insurance that long-term care pairing up with that. We call it a rider. And then yesterday you differentiated, and you'll talk more, but there are life insurance policies that focus more on life insurance with a long-term care rider. And then there are life insurance policies that focus more on the long-term care insurance piece. So that's a nuance there that's important. And then the fifth category would be just self-insurance. And we'll try to talk to the pros and cons of that. But the first scenario, this traditional long-term care insurance where we pay X amount dollars per month, we're covered based on the benefit that we choose. Amy, can you add to that any detail just to make sure I'm clear on the way I'm explaining that, and then maybe go into some pros and cons that you've seen before in those areas of traditional long-term care insurance?
Absolutely. Absolutely. So traditional long-term care is designed for long-term care expenses and long-term care expenses only. And when I talk about that, I'm talking about home health care, assisted living, and nursing home. Premiums are designed to pay for life or until you go on claim. Mm-hmm. It's the least expensive way to fund a long-term care policy. There's no death benefit associated to it. So it has that tagline that use it or lose it associated to it. So you could be paying into this for, 20, 30 years and you pass away and never use it. There's no benefit paid out to a beneficiary. Mm-hmm. So that's probably the biggest con with the long-term care, as well as the insurance carrier reserves the right to increase premiums in the future. So while it's priced out at a certain amount today, down the line, if the insurance carrier feels like they're have some concerns about claims paying ability, they have the right to go to the Department of Insurance and request to have a premium rate increase on that block of business. So you've got and there's well-known history of traditional long-term care having significant premium rate increases. So, that and the fact that you have to pay on it forever are probably two of the biggest cons. And there's no death benefit of a traditional long-term care. But again, it is a solid type of insurance. It pays for a good amount of long-term care. You can build the policy in order to fit within a certain amount of benefit. Mm-hmm. And there's inflation that you can associate to it, so it grows as you get older. So it's the oldest form of long-term care insurance that's been around the longest, and there's fewer carriers today that offer it than those carriers that offered it even 15 years ago. Companies have gotten in and gotten out of it. But it is a good solid contract. There's just, and it's not for everyone.
Sure.
It fits, has the right fit for individuals.
Yeah. A couple of things there you mentioned, and I've seen and experienced as well, are those rate increases. Mm-hmm. And that's pretty significant. I know I've sat down with some of our clients, and said, all right, do we want to continue this policy? It's gone up X percent. And it was quite significant for this particular client family. I'm not sure if the insurance companies have gotten a better hold on costs so they don't have to do such drastic increases. Maybe not. You would know better than I, but it was significant. And it was something we had to reevaluate every year. We're going to keep this policy because it keeps going up. But has that gotten any better that you know of, or?
I feel like it has. Mm-hmm. I've been in the business for a little while, and we started selling long-term care back in the late 80s. Mm-hmm. And it was not priced right to begin with. And they built these plans that had wonderful benefits, unlimited. It just was the stars were, the goal in these particular contracts. And the other concern was insurance carriers. They were just getting into this. So they were pricing it as though there would be, 10% to 13% of these insureds that would let their policies expire. So they took that into consideration as well. It turns out that it's got about a 1 to 3% lapse ratio. So people are hanging on to these. So in essence, they've had those premium rate increases. Some carriers have been 40%, some have been 60%. I have seen others that are over 200%.
Golly.
So it's crazy. And the ones that you see those higher rate increases on are the ones that have a 5% compounding unlimited bucket.
Okay.
Well, today, as you allured to, they don't have unlimited benefits that you can buy today. You can get 5% compounding, but there's also caps on what you can purchase today.
Okay.
Whereas, back in the 80s, you could start out at a huge number and have an unlimited plan. Well, today, your starting out is limited. And then you have your inflation associated to it. Plus, it's priced more appropriately.
Yeah.
I still believe, though, because of the history and they aren't guaranteeing the premiums that, if you're in your 50s or early 60s, you're not anticipating needing the care for hopefully 20, 25 years. I can't imagine that the insurance carrier won't still have a premium rate increase on that piece of business. But hopefully it's not as drastic as what those older plans are, because they were priced right to begin with.
Absolutely. Yeah, that makes more sense. I think the insurance companies, like you said, and a lot of them went out of business, or they went out of that business, I should say. Just they lost a lot.
Yes.
The last thing that I've noticed on this traditional long-term care insurance piece is that it seems like much more stringent medically. It seems like there have been folks that were either overweight or have something in their medical history where they were denied pretty quickly. Is that still the case, or are you seeing that?
The different, so, we're going to talk about hybrid, but with the traditional, typically today, the policy can be issued as applied. It can be modified or rated. So, you have a little bit more flexibility. But if with any long-term care, it is more stringent in underwriting than just buying a regular life insurance policy. They're going to look at your chronic health and, your family history, and, pre-existing conditions, because they're looking at underwriting for morbidity versus mortality.
Okay. Gotcha. Awesome. With that being said, we'll switch into the hybrid stuff, the hybrid types of long-term care insurance, meaning annuity or life insurance, big picture. I've worked with you in the past on a couple of these different types, and they seem to work. I think one thing that makes them the most attractive is what you mentioned about the traditional long-term care, is that with the hybrids, especially the life insurance ones, if you don't use the care, you can pass that on to your heirs, your children, if that's applicable. And so people tend to find a little bit of peace of mind on that one. In fact, my own parents, we used one of those types for them. And that was the last piece of their financial plan that was a little bit missing, mitigating that risk. And once we nailed that down, they were off to the races. They've enjoyed, retirement, just knowing that that's covered somewhat. But can you start us off with these hybrids, and I guess maybe the annuity version? Any pros and cons to that one? I know these are very, fit different circumstances, different people. But any thoughts on the annuity one?
Yeah. So on the annuity, it's an annuity, right? So you're putting in a lump sum amount of money, and it's accumulating at a rate of return. The long-term care rider associated to it is what's called an income accelerator. So you put the annuity in place, and then at some point in the future, you decide to turn income on. And once you've turned that income on, if then you see that you're going to need some type of long-term care, then your long-term care income accelerator will kick in and could increase that income by 1.5 to 2 times, depending upon if it's a joint or individual policy. And it will pay that increased payout for up to a period of 5 years. So it's not as healthy as of a benefit, but typically with an annuity, you don't have to go through any kind of underwriting. So it's an ideal in a situation if you have someone that is uninsurable for a hybrid LTC or traditional LTC, you would look to annuity.
Okay. Gotcha. That makes sense. And what you said there is important, where if I'm getting, for example, a $2,000 a month payout with this annuity, and then I qualify for long-term care, I might get, instead of $2,000 a month, I would get either $3,500 a month or $4,000 a month, depending on if, like you said, $3,500 if I'm covering myself and my spouse. If it's just me, maybe $4,000. Is that a good example of how that might work?
Exactly. Yes.
Excellent. The next kind we have are the life insurance ones. Probably tend to be, I think they're gaining popularity, it seems like. People tend to like these a little bit more. Whole life insurance, of course. And then on top of that, they have the coverage. If you don't need the long-term care coverage, then of course you have the life insurance policy. So starting off with the one, I think that, and you mentioned yesterday, they focus more on the life insurance part.
Mm-hmm.
Who is that? Who might that fit? And what kind of pros and cons do you think about when it comes to that life insurance with the long-term care rider?
Yeah. So most of the time, I'm finding that younger individuals are going after those types of policies because they still need some life insurance, but they want to cover long-term care also. They see the need in the future, whether it's through a parent or a grandparent, but they also want to make sure that their family has a death benefit in the event that something happens to them prematurely. So I see a lot of younger individuals in that scenario. With that particular type of policy, when I say it's a life insurance policy first, when you purchase this plan, you're purchasing a $250,000 or $500,000 death benefit, and that's where your long-term care comes from. Mm-hmm. It accelerates that death benefit at usually a 2% or 4% per month until that death benefit expires. And it's paid out. It can either be paid out monthly or annually. And when you've accelerated all of that death benefit, there's nothing left. It's over. It's done. But if you never need the long-term care and you pass away, then that full death benefit is paid out to a beneficiary. Mm-hmm. Another key point, and I didn't bring this up yesterday, but with these particular policies, you have to reapply for it every 12 months. So it's not that you wouldn't still qualify for benefit, mm-hmm. but unlike either the traditional long-term care or the other hybrid we're going to talk about, you apply for it each year. It doesn't just turn on and consistently pay out.
Yeah.
But it's a very affordable way to get some long-term care coverage or just have that long-term care as a bonus to your death benefit.
Sure. Wow. Yeah. So in this part where I got to qualify every year. So if I get diabetes or I'm diagnosed with diabetes or something like that, that would obviously play into this scenario. Then what would happen? How would that play out?
Well, the thing to remember is it's not necessarily the diagnosis of a disease. Mm-hmm. You have to meet one of those two triggers that we talked about earlier. So you have to be unable to do two of your 6 activities of daily living or suffer a cognitive impairment. Yeah. If you've met one of those two triggers, then you've been diagnosed as chronically ill, or you activate your long-term care rider, and then your benefit will begin to pay out. So just not necessarily the diabetes in itself would be a trigger in order to start pulling benefit.
Oh, okay. I thought you meant with that life insurance you said you get a medical.
Oh, no, you don't. Yeah, you have to accelerate the death benefit for long-term care. Oh, you have to apply for it every 12 months.
Oh, I'm with you. Okay. If situations come up. Oh, I see what you're saying.
Yeah. Not the actual insurance policy.
Okay,
itself.
Good. I was like, man, that's really aggressive.
Yeah.
I got to reapply every year. Okay, That makes sense. So if I have this policy, and then if I start to use the long-term care portion of it, then I got to apply every year or be evaluated every year, I guess. Okay.
Exactly.
That
Yeah.
makes more sense.
Yeah.
I'm with you. I'm
Yeah.
tracking now. Excellent.
Okay.
Yeah. The other life insurance one that you talked about that is more long-term care focused. Talk to us pros and cons on that one. I think yesterday you may have mentioned, hey, mid 50s is a range that's reasonable. But what are your thoughts on this one?
Yep, definitely. So early to mid 50s is an ideal time. And with this particular policy, it is a life insurance policy, but the death benefit associated to it is typically equal to about the amount of premiums paid in. So it's not a real large death benefit number, but then you've got your other bucket of money that's long-term care. And normally that long-term care benefit is in the first year is 2 to 3 times higher than what that death benefit is. And then that long-term care bucket continues to inflate and grow so that when you do need it in the future, unlike with the life policy, you buy a $250,000 policy and you've got a 2% accelerator, it's always going to be 250,000 and it's always going to be 2% on that. Whereas on this other hybrid, you might start out at $250,000, but you have a compounding of 3% compounding inflation on it. And so by the time you need it 20 years from now, it's going to be significantly higher on what you can pull from that life insurance scenario. The other uniqueness with these particular hybrids is they're typically a limit pay. So another reason why I suggest mid to early 50s, most individuals are still working and they can use their income to help pay for this coverage, pay it up in 10 years, and they've retired. And now they have this long-term care bucket growing and they're not having to use retirement dollars to continue to make premium payments and keep it going. So it's my favorite choice. I think it's the most comprehensive choice when you're looking for long-term care coverage. It's probably the Cadillac of all the choices.
Okay. Yeah. That we had this on our list to cover, but I think is a good point to cover now in this question. Like if I'm a young person, I've got the life insurance policy focused on life insurance with that long-term care, rider. But again, my main concern as a mid 40 something person is life insurance at this point in my life. Not talking about me. I'm much older than that, Amy. But anyway, can I switch to this more focused long-term care life insurance policy when I'm 55 or 60? Can I swap those two? Is that possible?
You can, but you have to go through underwriting in order to make that change, because it's already typically a permanent type policy on that life insurance focused benefit. So there's not any kind of conversion feature to automatically exchange. And then the other is if that carrier, there's more limited choices on the hybrid that is more long-term care focused. There's a lot more choices when it's a death benefit focused. So yes, you can make that change. And if you've built up any cash value in that policy, you can roll it into that other form of hybrid, but you have to go back through medical underwriting to qualify for the insurance.
All right. Because that's what I was thinking. And is that the 1035 exchange?
Yes.
Okay. Because I know we're talking about that now with a client case where they have a life insurance policy. It has cash value and they don't necessarily need it anymore. And we're working with you to change that 1035 exchange that into some sort of long-term care life insurance coverage, which I think is very helpful for those that, again, are in that scenario. You've had a whole life policy. You may or may not need that anymore, or may also need, I should say, long-term care. That seems to be a great option anyway.
Yeah, I completely agree. And that's an ideal situation when you've got individuals that at one point they did need that life insurance, but now it's that death benefit's not as important. So what do we do with this policy so that, we can maintain the value, the accumulated growth in it and maintain it as a tax-free benefit for long-term care?
Absolutely. Yeah, I think that's huge. I think there's probably a lot of people out there we're talking to that might fit that where, hey, I've got this permanent life insurance policy that has cash value, you may qualify or maybe an opportunity to do a 1035 exchange into something that's helps cover or mitigate that long-term care risk as well. So I think that's huge.
Absolutely. Yep.
The last technique for covering this, we've already alluded to it early on, was the self-insurance and paying for it. And you made a great point where, sometimes people can afford it. Like we can model this. Like we model this with our clients. We put it in a scenario. We did this just last week, and sometimes they can afford it, if that happens. But again, how do you model it? We can't model a 15-year, 10, 15-year type scenario. But then the question is, do I want to spend my savings on that cost? So it becomes more of a legacy type question. Again, the scenario might be, hey, we've saved our whole lives for this, our portfolio, our investments. If this happens, it could eat up the majority of those investments, possibly. So those are scenarios where maybe you can self-insure. Then it becomes more of an emotional decision on, do I want to or not? I think I would say the other thing there, Amy, that we see is, okay, if I do self-insure, does that mean I always have to kind of have in the back of my mind that I need to spend a little less to make sure that I'm ready for that scenario? So those are two things I think about with self-insurance, but it can be done, and we know that that's something we can look at as well, just to make sure we keep all options on the table. But any thoughts on that?
Yeah, I mean, we run into that a lot. I will just self-insure, which is absolutely fine. That's their choice if that's what they want to do. What I typically indicate is that, just keep in mind that when you self-insure, you're paying 100% on the dollar for that care. Whereas when you use an insurance policy, you're paying about 30% or 30 cents on the dollar for that care. So, again, it may or may not be a concern for that individual, but that's something to think about. The other consideration, if it's a husband and wife, and the husband needs the care or the wife needs the care, but the other spouse is healthy, well, they still have their lifestyle, they still have their home, they still have their way of life to support. Now they've got the added expense to care for this spouse. So again, their portfolio might sustain it, but they definitely need to make sure they take that into consideration in whether or not they want to leave anything behind to the kids. So sometimes ensuring one person can protect a significant amount of that portfolio, because the healthy person does intend to take care of the first person that goes out. All I'm worried about is when I go out on claim, or one or the other go out on claim, insure one, make sure one's got coverage, if not both.
Right. Yeah, those are good points for sure. And again, back to that emotional point where we were talking to a couple this week, and we said, hey, it looks like, again, there's only so much you can forecast or simulate. You're looking 20 years in the future, but it looks like it's possible for you to self-insure. But because of the personal experience, she was like, no, I don't want that. I see what my mother's going through. I see the care that it takes. I need this peace of mind. So everybody's different in those circumstances for sure, but some things to consider.
Well, and if you look at the cost today, like, you in your area, the average cost is around 10,000, where my mama is, the average, it's 12,000 a month. There's some that are lower, some that are higher, but that's today. What do you think that's going to cost 20 years from now? So, these facilities, if you drive down the road or through a suburb, you're going to see assisted living, retirement communities popping up everywhere. They're, it's growing. It's like popcorn. They're coming everywhere. So, what does that tell you the future holds, and the cost of these places? They're increasing it anywhere between 3% and 5% now. And could be higher in some areas. So, if you, like you said, further up north or out west, it's unpredictable. And the other example that I can give you is that, with my father, he had an unlimited plan. So he had one of those great plans, and he needed care for 3 weeks and passed away.
Mm.
My mother, on the other hand, is coming up on 5.5 years of being in a facility. And she used up all of her long-term care insurance, and now she's on Medicaid. But it's just, you have one all the way to the other. You don't know what it's going to be. So you just at least need to prepare for it with a portion of protection.
Mm-hmm. Something. Yeah. Back to the
Yeah.
something's better than nothing.
Yeah.
But as we close out today, a couple of minutes left, I know there were a couple of miscellaneous things that we talked a little bit too. And one of those we always try to learn more about is like the VA. A lot of our audience has VA disability. There may be some VA benefits. And we've not been able to wrap our brains around exactly when this might cover. In fact, what we've seen and maybe learned is it's probably going to be based off of a net worth, based off of your kind of like Medicaid, it seems like to us, based off of the need. And so I think with that being said, I wouldn't, and I'm a veteran as well, and I'm not going to plan on that for me. I'm going to use other means to plan for this risk, to mitigate this risk, than rely on this unknown VA benefit that may or may not be there. That's a tough part about that, so hard to plan for something that we can't quite define for sure, on the VA benefits, but.
Yeah. And the only thing I don't know a lot about the VA benefits either, but I can testify to an experience with my brother-in-law's father. He, was a veteran, and, it's unclear exactly how much that they would pay. And the worst part was he was put on a wait list. So he couldn't just say, "Hey, I need care, open up a room for me." He was put on a wait list. So while it might provide some benefit, I think that, we're unsure of how much it's going to provide and how quickly you're going to be able to start receiving those benefits.
Yeah, absolutely. That's a great point. The last thing is sometimes people want to give away stuff. Hey, I want to give away everything, my assets, in order to qualify for Medicaid. There's a lot more complexity there, but the one thing I'll say on that is there is a 5-year look back on gifting. If you decide to give a house or a large asset away to children, by the way, there's a whole nother, a podcast on giving assets away, which needs to be considered with an attorney and whatnot. But nonetheless, if that's the strategy, there is a 5-year look back that happens when qualifying for Medicaid. So I like to get that out there. That's one of the little nuances that's hard to fit in, the overall agenda there. But any thoughts or experience on that?
No experience on it that I've seen, but yes, you do see that a lot. I'll just start transferring everything. So, if for some reason you're 3 years in and you need care and you plan to use Medicaid, anything that you've transferred will be considered an asset and need to be spent down before Medicaid's going to start paying. So, it's not a bad thought, but you really need to start gifting that stuff a whole lot earlier. And maybe you don't want to give up that control.
That's right. Yeah. Like a lot of other issues there when you give stuff away, right?
Yep.
For sure. But well, Amy, this has been awesome. Thank you so much for your time today. And there's a lot of great lessons learned that I got out of this myself. So hopefully our audience did as well. You knocked it out of the park today. We give call signs to our guests. That's a pilot thing, a childish pilot thing, but we still do it, right? We're like little kids. And so you knocked it out of the park. You're from Louisville, Kentucky. So what better fit than Louisville Slugger? Slugger is a great call sign.
There you go.
So at this point, you can go back to the office, go back to your husband, kids, say, I'm now Slugger. Amy Slugger Arnett. So you can use that call sign. But no, Amy, thank you so much for the time today and your insight. It's been awesome and valuable to our pilot audience. So we appreciate you taking the time today.
Absolutely, Charlie. My pleasure. And it's been a joy having this conversation, and it's been great working together.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.